If you're doing it properly, you're using the safest financial vehicle in the last 1400 years. I happen to have an article here from Forbes magazine. It was written by John Gerard called "A Financial Bunker for Scary Times." I'd like to read this article to you. I think everyone should actually read this article. Suppose there was a financial instrument with a track record stretching back 1400 years that was so solid it could survive the Great Depression intact, that earned untaxed interest at a competitive rate, that could be borrowed against at will regardless of credit conditions, and that could be used by individuals as well as major corporations and banks as a safe harbor during economic turmoil. You'd call it a financial bunker for scary times, and you'd be talking about mutual whole life insurance. This is not the life insurance that only pays you when you die. Mutual whole life is the kind of insurance our parents and grandparents owned in the good old days before the stock market began to boom in the 1980s and 1990s. Mutual whole life saw our elders through thick and thin after several decades of being muscled aside by the allure of the stock market. I'm astonished at how few of the many investment advisors I meet understand how mutual whole life policies work, or don't offer them to their clients because they aren't sexy or new. I have to completely agree. Mutual or participating whole life insurance is the closest thing to owning your own bank. As New York Life has said in its ads, we're Main Street, not Wall Street. You own the bank. Mutual insurance companies are owned by the people who buy the policies. These companies are the modern equivalent of mutual societies among European trade guilds of the 1600s. Guild members pool their money to help each other and their families in times of sickness or death. Because mutual companies have no shareholders, they serve only one constituency, the policy owners. It's like owning being part of a credit union. Mutuals have no need to report good earnings every 3 months to justify a stock price. So there is no pressure for them to take on extra risk to make a profit. Your premium payments belong to you. Unlike traditional term insurance, the premiums you pay for your mutual whole life policy belong to you in the form of accumulated cash value of your policy. On top of that, the cash value of the accumulated premiums earns interest at a rate set once each year. In 2008, Guardian Life paid a record 7.3% dividend interest, and those earnings are untaxed. That's spectacular compared to last year's over 30% decline in the stock market, bank CDs paying under 2% taxable, or the money market rates under 1%. And I'll also point out too, it's not in here, that the consumer price index was under 2%. So that's actually growing your wealth if you actually got into one of these mutual insurance companies. We're picking out a couple, but there are other ones out there, both in the United States and Canada.